Module 6.2 is going to follow very closely Module 6.1, but rather than looking at equity index futures contracts, we'll be looking at selected other futures markets. And specifically, we'll look at metals, energy, soybean complex, the wheat market, as well as US versus China metals. The goal is to identify markets that appear to be fully arbitraged. If you remember from Module 6.1, if the markets exhibit the existence of arbitrageurs and it behaves as a fully arbitraged market, then the correct valuation model, or the valuation model that should work the best, is the carry arbitrage model. If, in fact, the underlying instrument is not arbitrageable, or there are just such severe impediments to arbitrage, then perhaps we should look at other valuation models such as the futures expectations theory or the net hedging hypothesis. And so the goal is really to become increasingly familiar with the valuation of futures contracts. By valuation, I'm not referring to the zero value after we mark to market. I'm referring to how the equilibrium futures price is determined due to market forces. Again, if you look at the gold futures market, you have the spot price in the third nearby futures contract. Again, the big takeaway from this figure is the two track very close together. The third nearby basis is generally negative. It's hard to see the zero line right in here, but there's a lot of randomness, and in part because the settle price for gold is not at the same time as the futures price, and so you get this noise. The basis is very noisy. However, if I look at the marginal term premiums with gold, a couple things to observe. One is it's not unusual to have data points. And so it turns out when you're working with empirical data, it's extremely important that you make sure your data is cleaned up. A second observation here is that the 3-month LIBOR rate and the third marginal term premium track very close together, at least for the back part of this data set. Initially, the marginal term premium is reflecting an additional significant carry cost or less carry costs than just the LIBOR rate. So perhaps this market was not a fully arbitraged market at this point, but became so over this window of time. We now turn to examining the silver market, and we notice a very similar pattern. That is, there's disruption in this first 5-year window, and then it becomes the marginal term premium tracks the LIBOR rate much more closely. So perhaps the market was not fully arbitraged back then, but became so because this is a human science. Copper is an interesting study. The futures price clearly tracks with the spot price. The nearby basis is quite noisy. If you'll notice, this axis has been expanded in order to reflect all that noise. However, when we look at the marginal term premium, again, we let this be much more negative and we widen the range. But what we observe here is the apparent lack of reverse carry arbitrage in these two windows of time. But outside of that, it appears as if there's that somebody's paying attention to the carry arbitrage transaction, and therefore the market doesn't get too far disrupted in the relationship between the second nearby and third nearby with regard to the third nearby being significantly higher. And so the copper market maybe has now have arbitrageurs willing to do both sides of the trade, and that we'll never observe this again, but it's an open empirical question. If we look at just a 5-year window, 2014 to 2019, we see that gold generally reflects the LIBOR rate plus a slight additional carry cost. Silver has the LIBOR rate plus a significantly more carry cost on average. And then copper goes back and forth, but doesn't deviate too far from the LIBOR rate. And so clearly there's a relationship between the financing charge and the marginal term premiums, and the marginal term premiums trade within a very narrow range. We now turn to the energy market, and as I would assume, understand, is that this is a much more difficult market to arbitrage, and so the ability to short sell a barrel of crude is much more difficult than the ability to short sell a bar of gold, because it's easily storable. There's a market that covers this sort of thing. And so if we look at the data, the first thing to realize is I've changed the axis to minus 100 to plus 100. Otherwise, I wouldn't capture most of the movements in the energy market. And so Brent and West Texas Intermediate exhibit both the arbitrage opportunities with reverse carry as well as with carry. And so you get clear evidence that the market does not reflect, is not fully arbitraged. And so the carry arbitrage model should be replaced with something else. Diesel behaves somewhat like Brent and West Texas Intermediate. Unleaded gasoline is a classic illustration of seasonality. And natural gas has the same sort of seasonality, but the behavior is a little bit different. Gas is in high demand in the winter. Unleaded gas is in high demand in the summer. There is an interesting anecdote with natural gas for which I don't have an answer for. It appears as though during this window of time, surrounding December 2009, perhaps somebody was engaged in reverse carry. So if you're working at a major energy company, have access to supplies that you can sell out of inventory and buy back with the futures contract, that arbitrage activity would have been very profitable, and perhaps that's what you were doing here. If I happen to be reading your mail, so to speak, or you're aware of activities that went on in this window with natural gas, I'd love to hear from you. Heating oil has a similar pattern. Notice the deep profits available for reverse carry that seem to have vanished in the recent past. And so perhaps arbitrageurs are more active now than they were in the past. The soybean complex is a great place to learn about this distinction within the futures market. Soybean oil is storable. Soybeans are grown, they're crushed, and they produce meal and oil. Meal is not as storable as oil. And so we would expect arbitrage activity to be easier with oil than with beans or meal. And so this is soybeans marginal term premium. Soybean meal marginal term premium. And what should just leap off the page is it appears as if somebody's willing to do the carry arbitrage, that is, buy the underlying and sell against a futures contract, but they're not willing to do the reverse carry. And so this is what I would refer to as a quasi-arbitrage market. There are arbitrageurs active on one side of the market, but not on the other. Perhaps in the last few years, they've become more active on both sides of the market. Soybean oil is a completely different story. It's clearly much more, better reflects being fully arbitraged than soybeans and soybean meal. And so this kind of analysis is important to understand the nature of the commodity in which you're either hedging or speculating. Wheat, there was a unique event in 2007, 2008. There was a world shortage of wheat in the 2007 harvest year, and then a world abundance of wheat in the very next year. As you might expect, when wheat prices spiked way up, what do farmers do? They plant a lot of wheat. It turned out the weather was near perfect, and the harvests were great in both the northern hemisphere as well as the southern hemisphere. The harvest season generally starts in April, I believe, out of India, and there are two different seasons depending on which hemisphere you're in. And so what we see is a great opportunity for a reverse carry arbitrage during the shortage, but nobody willing to do that transaction. And so if we look at the two harvest years under a microscope, we observe that during the world shortage that there was a reverse carry was available for soybeans and soybean meal during this window of time, but the shortage was not as great with soybeans as it was with oil. I'm sorry, with wheat. Soybean oil, that just it's a near perfect track with the financing cost plus a little more. The wheat, on the other hand, because it was in a shortage of supply, we had this disruption here, but then it goes right back to being reflecting a fully arbitraged market. The final thing I want to explore briefly is what happens if we look at the same commodity but in different countries. The U.S. and China are structurally different. In the U.S., there's liberty. In China, there's what I refer to as statism. And so does that make an effect? Well, if we were physicists studying a physical phenomenon or something in the natural sciences, you would expect not to find any difference. Location shouldn't matter that much. But we find a significant difference, and we find the U.S. reflects carry arbitrage. China does not reflect carry arbitrage in gold and silver, but there's a unique observation out of the copper market. And so if you look at the Chinese gold marginal term premium, a third nearby versus second, you can see a radical difference compared to the U.S. If you and I were in China and we could do the arbitrage trades that U.S.-based arbitrageurs are doing with gold within the U.S., there would be literally millions of dollars to be made with reverse carry as well as with carry. But there are structural differences. There are a host of structural differences that cause arbitrageurs not to be active in the same way that they are in the U.S. Silver has the same sort of phenomenon in that there's a lot of noise in the marginal term premium in China, but that is non-existent in the U.S. Copper is interesting in that copper actually reflects the existence of some arbitrage activity within China, but it's much stronger in the U.S. And one possibility is that foreign arbitrageurs are allowed more liberty within China than gold and silver because China is heavily dependent on the world for copper supplies. So the cultural explanations, well, there's a well-known inherent contradiction between the tenets of statism and futures markets. I mean, by definition, the rule of law, the clean property rights, and a culture of trust are typically not found within statist-run countries, whereas they are found in liberty-based countries. And so it's not surprising that arbitrageurs may be more active in a more liberty-based country. In China, futures traders do not have direct access to financing in general. I don't think you'll find that published anywhere. I happen to stumble across that in conversations with Chinese-based futures traders. There's deep regulatory ambiguity within China. One of the challenges if you trade, even as a Chinese citizen within China, the regulatory structure, as I understand it, is ambiguous in the sense that you're told you need to, by analogy, you need to drive at a reasonable speed on the interstate. Well, that's not helpful because to one police officer, reasonable might not be the same as to another. And China also has a unique attribute in that there's a high volume of short duration retail market participants. It's a deep gambling kind of environment. The analysis in this chapter is the same as the prior, and I'll skip it. And so the main takeaway is carry arbitrage does work in gold and silver, a little bit in copper. It doesn't work in energy, perhaps soybean oil, but not meal and soybeans. The wheat market, if there's a large amount of inventory, but not if it's in shortage. And this arbitrage analysis varies depending on what the regulatory structure is.